Martin Skanberg, you're fund manager for European equity, continental European equity at Schroders. What's your assessment of the markets as we slowly move into 2016?
Well, it promises to be certainly very exciting, obviously, with the tragic events we've seen in the very recent past, coupled with very sizable monetary stimulus, coupled with some fairly high expectations in certain parts of the market, specifically the quality and the growth sectors. It really sets you up for a very interesting 2016. So what we would be looking for is really a continuation of some very good support from the ECB, the QE1 plus or the QE2. We should also expect some fairly decent earnings recovery coming from the domestic consumer-facing sides. So, you know, a good consumer boom in some extent for the Eurozone in particular, highlighted also with some risks, specifically on the manufacturing side. So even though the weak euro will help to alleviate some of these concerns, we still see a deflationary threat impacting the manufacturing sector going into 2016. So we favor very much a euro-centric domestic recovery, which should provide you with good earnings momentum.
You mentioned the ECB and the quantitative easing, but what other aspects could there be? What other drivers could there be in Europe for more growth?
Well, Europe also sits in a fairly good position fiscally in some ways. Years of austerity, specifically in Southern Europe, Spain, is now starting to end. And you can see GDP growth progression is actually very, very good right now. So the fiscal position, which will come very much in handy given the migrant situation that we have in Europe, will be an incremental boost to the economies going forward. So overall, we think that fiscal spending plus the underlying recovery we're seeing in Southern Europe, plus a very solid disposable income growth when you look at Germany, when you look at France, really bodes quite well for consumer spend.
You mentioned the manufacturing business, but in an overall view, where in Europe, in what sectors do you see the growth opportunities, and where don't you see them?
Well, I mean, clearly the consumer side will do well, and we do have some broad-based concerns about the export sectors. Now, having said that, there are always good pockets of growth, even within the industrial sectors. You know, if you look at automation and robotics, you know, we do have a lot of investments that caters into that space. But we're also very keen on some of the financial sectors. Yield compression and the negative bond yields that we have across the Eurozone means that a lot of the real estate and the property sectors are looking quite attractive to us. They've done well, and we continue to expect them to do well. I'm thinking about the German residential property sectors, which is enjoying good rental growth and obviously yield compression. And then obviously banks, which sit right at the heart of any economy. The credit cycle in Europe and the Eurozone in particular has turned positive. It's been positive for the last year, and this is really amplifying the efforts of the ECB. So we see selectively some good opportunities within the domestic Eurozone banking franchise, as well as the asset managers, to really leverage this monetary policy that we're seeing.
Banking industry is, of course, a big issue in Switzerland, and the Swiss equity market has recently been dubbed as one of the most promising in the world or in Europe. Do you share that view?
Well, certainly it's been a tough year for Swiss equities. Not so much for the underlying companies themselves, but clearly the event back in January really sets the tone for declining earnings momentum. That's still continuing. So Switzerland is a bit of a special animal in this case. That, you know, if you look at the third quarter numbers, which we've just concluded, Switzerland continues to see earnings declines coming through. But within this, you know, we still see a lot of excellent franchises. The quality of the pharmaceutical sector has obviously been particularly buoyant, and we see still some good restructuring stories there. And as you mentioned, the banking space selectively also has some self-help stories, and these are the type of things that we're looking for. And specifically with regards with the wealth management side and Credit Suisse in particular, we see some good self-help restructuring opportunities.
Now, going back to the future and looking at Europe as a whole, where do you see possible deal breakers, major risks for the European recovery? I mean, from the rise of protest parties, monetary policy, negative interest rates, down to the terrorist threat that we've seen now. Where do you see the major risks?
Well, in terms of terrorism, obviously that could really cause consumer confidence to buckle a little bit. But I think the reality is that life goes on, and we're seeing the markets respond very well to this. So I don't necessarily put that into the highest category. I still feel that the deflationary pressures coming from the macro imbalances of the emerging markets could still continue to impact the profitability that we're seeing in European equities. So specifically with regards to the low margin exporters, industrial sectors, we still see certain risks involved in that. And as ever, we need to think about Greece. Clearly, tremendous progress has been made over the past 6 months, a bit belated, but we're seeing the final touches now on the third bailout program, with the disbursement coming due very, very shortly here. So we're reasonably optimistic that, in fact, even Greece can offer some upside into that. But clearly, the political situation can change at a moment's notice, but we don't necessarily see that as a systemic risk right now.
Interesting times. Martin Skanberg, thank you very much for your insights.